Big news just dropped. The Fed just cut interest rates for the first time in 9 months. We're talking a 25 basis point cut that immediately pushed mortgage rates down to around 6.1%, which is now being hyped up as a 3-year low. And if you've been scrolling through CNBC, Instagram Reels, or maybe even listening to your realtor buddy, you've probably already heard the spin. Buyer demand is about to come roaring back. Home prices are going to boom again. Refi applications are exploding. But hold up, before you go rushing into the market because the Fed trimmed a quarter point, let's talk about what's actually happening here. Because this exact same situation played out last year, and spoiler alert, it did not end well. And by the way, if you guys are interested in current trends in the housing market and looking for opportunity, click the link down in the description below to subscribe to our Deal Watch newsletter. We send one out every single week for free. You can grab that by clicking the link in the description below. All right, so let's rewind. September 2024, the Fed cut rates. Mortgage rates dipped. Everyone screamed, housing rebound incoming. You remember the headlines? But then reality hit. Instead of a boom, demand sank like a rock. By early 2025, we had the lowest homebuyer demand since 2009. Yes, straight back to financial crisis levels. Remember those days? Not super pretty. I lost a lot of money. So why did this happen? Because temporary dips in mortgage rates don't magically erase affordability problems. Prices are still near record highs. Mortgage payments, even at today's low 6.1%, are about $2,650 a month for the average home, almost double the pre-pandemic level. Compare that to long-term norms around $1,900 and you see why buyers still feel locked out. A slightly smaller monthly payment isn't enough to convince people to dive in. And here's the kicker. Last year, rates initially fell after the Fed cut and then shot right back up into the 7% range within months. So anyone who thought they were looking in, quote, the bottom, quickly realized they jumped the gun. History might just be repeating itself. Meanwhile, let's check in with the builders. Because if anyone has their finger on the pulse of demand, it's them. They're slashing prices 15 to 20%, offering crazy incentives like 1.9% teaser mortgages for the first year, and in some cases, permanent 4.99% rates. We've talked about all these things on previous episodes. Make sure you hit that subscribe button so you don't miss a video when it comes out. But even with those giveaways, you guys, they're still struggling to move homes. Builder sentiment just hit its lowest September reading since 2011. That's brutal. If rates falling to 6.1% was really enough to reignite demand, the builders wouldn't be this desperate. So what does all this mean for buyers right now? Honestly, it's good news. Every time rates come down and the market still doesn't take off, it puts more pressure on sellers. Inventory keeps climbing and prices in many states, Florida, Texas, Arizona, even parts of California, if you want to live there, are already sliding. Nationally, a third of states are showing year-over-year declines, and about half the country is seeing month-to-month price drops. That trend is your friend if you've been waiting on the sidelines. Now, here's the math that really matters. To bring affordability back in line, we need two things to happen. Number one, home prices dropping around 15%. Number two, mortgage rates closer to 4%. That combo would bring average payments back to the $1,900 a month range, the sweet spot where buyers flood back in. And then don't get fooled by a headline that makes a tiny dip look like a game changer. So yes, the Fed just cut rates. Yes, mortgage rates are at a 3-year low. But no, this doesn't mean the housing market is saved. It just means the correction has little more room to run. If you're patient, the next 12 months could bring you far better deals than what you're seeing today. And speaking of deals, click the link down in the description below to sign up for the Deal Watch newsletter. One of the biggest signals I track is inventory. In markets like Tampa, Orlando, and Phoenix, inventory has been exploding. That's why we're already seeing price drops of 5 to 10% year over year, with forecasts pointing even lower in the next 12 months. In other words, while the headlines are busy telling you demand is coming back, the real story is that in certain zip codes, sellers are quietly panicking, and that's where the opportunity lies. Shh, don't tell anyone. Bottom line, don't let FOMO push you into overpaying. Watch the data in your local market, inventory, sales, price cuts, not just the national headlines, because the people saying buy now before rates fall further are usually the same ones who told us last year the market was about to boom, and we all saw how that turned out. All right, if you like this video, hit that subscribe button. We'll see you on the next one. Bye!